Welcome to It's the Economy. Axis Capital India Conference is underway, and joining me from the sidelines of the conference is the big man from Axis Bank, Amitabh Chaudhary, Managing Director and Chief Executive Officer. Amitabh, thank you very much indeed for joining us, finding time for us on a busy morning. But what's the theme that is driving this conference? What are you looking for and whom have you invited?
So, Latha, firstly, thank you so much for inviting me to your show. Well, Axis Capital has been around for a long period of time. We have been doing this conference annually. This is that annual conference. But I think what is different about this conference is that the number of companies which are coming to the conference is the highest ever we have seen, 165 companies odd, 600 investors. But more importantly, as we have revamped our research side of the business under Neelkant, we have started publishing some real, futuristic stuff in terms of what we expect to see in India in terms of on the PV, on the electronic side, on the defense side, on the Fintech side. So, and as we have published these reports, I think we are going to have a number of sessions around each of these themes, and obviously have industry experts come and talk about it to give the participants an opportunity to not only understand and appreciate as to what our house view is, but also get to hear from the experts in terms of what are some of the themes which could evolve and become investable in India going forward, or become big opportunities in India going forward. So that's a big change, and obviously we will continue to build on it as we move forward. Looking forward to a very successful conference.
Oh, yes. And we have also benefited from Axis Capital and Axis AMC's reports, in particular, Neelkant pointing out the amount of, securities that the US government is going to issue and the impact it is having on the global cost of money, or even Ashish Gupta's gamification of equities and the amount of F&O, positions, all those most useful. Everything that's coming from your stable. But I want more from you on the present situation. The Reserve Bank's monetary policy was neither dovish nor hawkish, and the flow in the call market is still ruling at 6.75, 6.8. So is this war for deposits not getting over anytime soon? How do you see it moving?
So, Latha, we have a unique situation where, apart from the geopolitical factors you just mentioned, we have a fiscal consolidation going on. Monetary tightening is still very much there. Our exports of goods and services is slowing down. RBI has asked and questioned the banks on CD ratio and what is their strategy to manage it. As you rightly said, the call rates have gone up. The bulk deposits rates have gone up by 1%. The credit growth, for some reason, is not coming down. I think banks are continuing to lend and pushing for growth, which does mean that there is, if the monetary tightening is there, deposit growth has been constrained, and so there is a bit of a war for deposits going on. It cannot continue, it cannot sustain. I think a couple of things why. One, RBI itself is hinting to the market and to the banks that they need to slow down a little bit. They're also, and that's why where the CD ratio comes in and some of the messaging from RBI, they've also increased risk weights in certain asset classes where they're seeing growth which from their perspective is a bit too high for their comfort. And also just the nature of things that, you cannot sustain a credit growth without deposits backing it up, the right kind of deposits. Otherwise, you'll, be destroying or changing the nature of your balance sheet over a period of time, which will not be the right thing in the long run. So my view is that the deposit and the credit growth has to converge. I also believe that RBI, given its clearly stated stance that they need to get inflation down, while the core inflation is down, the headline inflation remains high, remains volatile, and they will continue to work towards it, which means that liquidity will remain tight, which means that the interest rates will remain higher for longer. And if all that is going to continue, I do believe that at some stage the credit growth has to come off, or the interest rates have to increase much more than where they are today, and obviously the full transmission has not happened. And as interest rates increase, hopefully again the credit growth will have to come down.
Okay. Well, Bank Nifty is quite clearly the underperformer compared to Nifty. And perhaps the market is telling us that they have already seen peak margins and peak ROAs and peak ROEs. Would you say that margins have peaked? And more importantly, can they fall further? Because you did see a good 25-30 basis point fall in margins already.
So, Latha, you're right. If you look at just the private sector banks, the top 25 private sector banks, the margins are off 40 basis points on an average from Q4 23. And yes, as we just talked about the fact that the repricing of deposits is still happening, while the repricing of loans is taking its time, and because of the credit growth and competitive intensity, maybe the repricing of loans is not happening to the extent it should. Hopefully, it will play out a little bit in the next couple of quarters. But if we were to assume deposit growth is going to remain constrained and competitive intensity on the credit growth is not going to reduce or not going to reduce enough, it does mean that the NIMs could continue to remain under pressure. Now, every bank's, its balance sheet, its mix is different. They have their own set of factors which will determine how their NIMs move. But yes, in the short term, NIMs could be under pressure because of what is going on in the market. Now, we also know that at some stage, all of us are predicting, the timing could be an issue, that the interest rates will be cut. And when the interest rates are cut, we also know that, again, the loans will reprice downwards faster than the deposits. And at that time, again, you could see a cycle for some time where NIMs could come under compression. Now, over a period of time, hopefully, they'll find the balance and NIMs should stabilize at the same level. But there will be a period during which you might see some compression on NIMs because the loans are just repricing faster than deposits. So all of us are aware of these facts. All of us are looking at levers to ensure that the volatility on NIMs is not there or the NIM compression is not there. And as I said, so a lot will also depend on individual banks in terms of what they do, how do they react, what is more important to them, is credit growth more important to them, is NIMs more important to them, is ROEs more important to them, overall profits is more important to them, and they have to balance all these factors to ensure that whatever they've been saying they want to do, they're delivering on consistently.
Okay. Can your credit costs fall even further, Amitabh? I mean, as a percentage, I mean.
No, Latha. Well, if you look at the NNPAs, they've fallen from, March 23 further in December, from 3.9 to 3%. I don't think the credit costs can fall further. I think you're pretty much at the bottom of the, zone here. I think the credit costs have to move up. Firstly, the recoveries, the lumpy recoveries which the banks have seen are only going to reduce over a period of time. And secondly, we need to start moving towards the mean back up. Now, obviously, we're going through a period where generally the portfolio quality is behaving very, very well. We are seeing some signs, generally in the system on personal loans and something on the credit card side. But I would say nothing on the horizon which tells me that the credit cards are going to increase immediately. But, in the next 6 to 8 quarters, they have to move up. I don't think they're going to come down further. Where is the scope for them to come down further?
Yeah, no, at 0.3% annualized, it's really tough to see how things can. But I just wanted it clarified. Okay, but let me come to a question, separate
so I think,
from
I think
this.
all these costs are coming from the retail side. Sorry.
Yeah. No, go ahead, please.
No, I was just saying that, most of these credit costs you're seeing on the retail side, the wholesale side credit costs are ones which are at historical lows. So at some stage, you will, all the fresh lending all of us have done, will start seeing some, and a lot of lending has happened to the SME and that sector. We will see some credit costs coming up there also and kind of rising a little bit. That's just
one niggling worry in your Q3 results. Why were the operating profits so much lower than we thought? It's even lower QOQ.
Well, there are a couple of reasons driving it. You very well know that our NIMs came off a little bit, and obviously that has a huge impact on your overall operating income. We also, while continue to see very healthy growth on the fees side, sometimes the trading profits tend to move up and down, and that causes things to move. At least as far as operating profit is concerned, a bit sideways. And then, yes, given where we are in terms of return on equity, we are continuing to invest for the future. And that means that our expenses have remained elevated. We have told the market consistently that if we are able to deliver the promised ROE, which is kind of the benchmark or the North Star for us, we will use that opportunity to invest for the future. So, yes, the expenses were also elevated. We believe we can control them when we need to. But we will continue to invest as we move forward. And also, please don't forget that we are still going through the transition on the Myrtle side. We continue to incur expenses, technology expenses on the Citibank acquisition, which once that transition is over will come down. So there are a couple of reasons which are driving it. And that's how we explained it to the market.
Okay, fair enough. Now, let me come to just the quote we got from you when you were launching your Hurun card, you said that you are very willing to take over, have a relationship with Paytm customers, provided the regulator has no problem. You have to go and take specific permission? I mean, after all, you're only taking customers from them. A specific permission is needed?
No, so Latha, it is the question is not of that. The question is as to how that transition will happen. Firstly, we are very clear in our minds that, for example, I'm just giving an example, not that, anything is done or signed with the Paytm, but I'm just giving an example that let's say the merchants of Paytm were onboarded by us. We have to and we will insist on doing individual KYC. Now, that cannot be done, for example, by February 28th. So it does need time. So when I say we need permission from RBI, we need permission from RBI in terms of saying that, yes, this is the roadmap you can take. We are okay with that roadmap. We are okay with the time you might need here. And we will be watching you very, very closely. But we do need RBI to bless it, because we cannot, just suddenly take over all the merchants and say, by the way, I'll take 12 months to do KYC. I mean, we cannot take that problem on our, on ourselves unless RBI gives us some kind of dispensation. So I'm just giving an example. Same thing can happen on the FASTag. Same thing can happen on the nodal account. So my view was that RBI obviously is looking at the matter very closely. I'm sure Paytm is in discussion with RBI. And depending on what view RBI takes on what has to happen up to February 28th and beyond, we are happy to work with Paytm. They're a large fintech player. They have a large number of customers. There will be some market disruption. We are very happy to support generally broadly the customers and customers of Paytm in this story. We have had a relationship with Paytm for some time. And that's what I was referring to when I made that statement.
Okay. Yeah, fair point. No, now I understood. Typically, I would really want to know how many customers you can do KYC in a day. That'll help. But besides that detail, since I'm running out of time, can you tell us the update on Max? I mean, now the share purchase is over, and what's the future relationship looking like?
So you are aware that, recently our Deputy MD Rajiv Anand was appointed as the chairman of Max. We will have the right to appoint majority board members once our equity stake goes up to 19%. What RD has approved is this investment. We are still awaiting CCI approval. So my expectation is that the real investment will happen into Max in the first quarter of the next financial year. We obviously have the internal approvals in place, both from Axis Bank and Max's side. We have RBI and now the regulatory approval in place. We do need to get the last bit of CCI approval, which is in process as we speak. Obviously, Max is a very important and strategic investment for us. We are committed to support the growth story of Max. We believe it's an incredible company with a very, very solid management team. And our role there would be to support them to become bigger, better, and continue to make an impact in the marketplace as they've done in the past. I mean, they were the only independent, not bank-backed insurance company which has done so well over a period of time. And we are obviously looking forward to this, higher level of engagement with them as we move forward. Okay.
All the very best to you, both for Axis Bank and for the conference that's underway. Thank you very much for sparing time for us in what must be a very busy hour for you.
Thank you so much, Latha. Thank you. Thanks a lot.
Well, that's the word from Axis Bank. And incidentally, banks have bounced back very well. The index itself went up 1.1% from actually being about 0.9% lower. So there's a sharp jump that's come in the banking sector itself. In fact, all the indices are in the green. And the mid-cap is almost getting there on that auspicious note. We wind up on Bazaar. Third Partners coming up.